Hello everyone, I'm Angela Corpus. Last time we discussed about the chapter 6, which is the notes receivable, and the chapter 2, which is the bank reconciliation. So today we were going to discuss the chapter 11, which is the inventory cost flow. So first, what is inventories? Inventories are assets held for sale in the ordinary course of business in the process of production for such sale in the form of materials or supplies to be consumed in the production process or in the rendering of services. So inventories contains the requirement on how to account for most types of inventory. The standard requires inventories to be measured at a lower cost and net realizable value and outlines acceptable methods of determining cost, including specific identification. We have the FIFO or first in first out and weighted average method. So we have here the inventory cost flow methods. There are many methods. So we have a specific identification method, average method, FIFO, and LIFO. So we will use only the two methods, which is the average method and the first in first out method. So cost formulas, we have PAS2 paragraph 25 expressly provides that the cost of inventories shall be determined by using either first in first out or weighted average. The standard does not permit anymore the use of last in first out or the LIFO as an alternative formula in measuring cost inventories. So first in first out or FIFO method is an accounting method assumes that saleable assets such as inventory, raw materials, or components acquired first were sold first. So it is a widely used method of valuing an inventory globally. It is the most accurate method of aligning the expected cost flow with the actual flow of goods, which offers businesses a truer picture of inventory cost. It reduces the impact of inflation, assuming that the cost of purchasing newer inventory will be higher than the purchasing cost of older inventory. We also have the weighted average method. It is a method for inventory valuation or delivery cost calculation, where even if inventory with different numbers of units is accepted, a calculation can be performed by weighing quantity to the unit price. So it is more sometimes accurate than a simple average. The primary benefit of the weighted average cost method is that it levels out the price fluctuations. So we have here a sample problem. Bronze Company had the following transactions relating to inventory during January. January 1, balance on hand units of 6,000, a unit cost of 150. January 5, purchase 2,000 and a unit cost of 200. January 10, sale 4,000. January 15, sale 1,000. January 20, purchase 2,500 and a unit cost of 300. January 25, purchase 2,000 and a unit cost of 400. And January 31, sale of 3,000. So we have to determine the ending inventory under each of the following costing methods. We have the FIFO and weighted average method. We have here the first method, which is the first in first out. We have the date, January, and January 20 and 25. So the purchase of 2,500, unit cost of 300, multiply, we have 750,000. And January 25, we purchased and units of 2,000, a unit cost of 400, multiply, we have 800,000 to the total units of 4,500 and a total cost of 1,550,000. So we have here the weighted average method. We have the date, January 1 to 25. The units, unit cost, total cost. Within January 1, balance of 6,000, a unit cost of 150. Multiply, we have 900,000. January 5, purchase 2,000, unit cost of 200. Multiply, we have 400,000. January 20, purchase 2,500, a unit cost of 300. Multiply, we have 750,000. January 25, purchase 2,000, multiplied by 400, we have 800,000. So We have here a goods available for sale of 12,500, 228 of unit cost, and a total cost of 2,850,000. So 2,850,000 divide 12,500 is equals to 228. Then multiply 4,500 to the unit cost of 228. So we have 1,026,000. So thank you and good day.